18% to the downside for the Euro Stoxx 50. Does that represent the risk that Europe faces right now, do you think?
It's hard to price in the risks exactly at this moment in time. But the one thing that I've been really watching actually is what analysts are doing in terms of their earnings expectations. And we haven't seen widespread earnings downgrades in the US or in Europe yet. I think that kind of marks the sort of paralysis that we're in, that analysts don't know the full extent to which this inflationary pressure from energy and commodities will affect consumption, and the effect of this ongoing conflict in Russia and Ukraine will have on overall activity. So it's hard to say that all of the bad news has been priced in at this point, or that we actually have seen the most aggressive moves that we'll see before we kind of bottom out. I wish I had better sort of more positive tone there, Guy, for you.
Okay, so Kate, if the worst could still be to come, where is the safe place to hide out?
Everyone on the street is talking about the same thing at this point, Kailey, which is like hiding quality assets. But I have to say, even those companies with awesome balance sheets, like fortress balance sheets with high free cash flow generation, are not necessarily reacting well to these headlines on geopolitics and headlines around energy. In fact, some of these companies are also derating, and you're seeing a significant sell-off because they are liquid and well-owned, and it's possible for people to reduce their risk. I think you should have a shopping list ready. I don't know that you need to start buying anything right now, but high quality companies with sustainable free cash generation are definitely where we want to be through the end of this year.
What about energy? Energy stocks, commodity stocks broadly, but certainly energy stocks off to the races so far this year. And portfolios, if they don't have these energy stocks within them, are certainly suffering and underperforming. There's an ESG factor here that you've got to consider too, Kate. And then there's just the possibility that maybe things actually stabilize and energy's gone vertical. It could come down in a very meaningful way very quickly. What do you do with energy? Do you buy it still? If you've got it, do you sell it? What's the strategy?
Yeah, Guy, we have been pretty constructive on energy going into this conflict. So we were looking, like many people, at the supply-demand balance, and we were looking at a kind of robust global economic backdrop for the course of 2022 and 2023 with more constrained supply. And of course, something we've often talked about in terms of the energy companies, this capital discipline, which would lead them to reap outsized profits at higher prices. There's a big question right now, to what extent do these higher energy prices end up leading to a demand destruction? And so I think that's an ongoing question. That said, we're continuing to hold our overweight in energy stocks for the time being, although we would not be aggressively adding at this moment.
Okay, so obviously higher energy prices, we can have the conversation about demand destruction, but obviously it feeds into inflation, which in theory, the central bank reaction function should kick in to combat that. But if you also have a real growth risk out there, Kate, what is your expectation about how central banks' calculus may have shifted in just the last couple of weeks?
Yeah, Kailey, it's a great question. And I have to say, alongside many others, I'm very glad that I'm not a central banker at this moment in time, not responsible for making these really difficult decisions. Because you're right, we have this rising inflationary pressures that may end up affecting overall activity. We've heard the term stagflation come into discussions. It's now part of the common lexicon, as it were. But it's too soon to tell. I think it's prudent for the Fed to begin the process of policy normalization, but to stay really on top of what happens to consumption as a result of some of these higher prices. We were very much of the view that the Fed should have begun tapering asset purchases in the middle of last year. So, finishing the taper and raising rates a little bit off the zero bound makes a lot of sense for us, but we'll have to be monitoring this on almost a daily basis.
Kate, what poses the greater risk to portfolios right now, inflation or growth?
I worry a little bit more, Guy, around inflation, frankly. Inflation both in terms, especially as an equity investor, frankly, how companies are able to pass on higher prices, where companies are able to sort of substitute or shift their business models. Margins are really coming into question, something we've talked about for years, but this is the moment, actually, where margins really matter. And a decline in profitability is going to really take off some of the optimism around equity. So that's what I worry about a little bit more, because we know that some of these secular growth companies are able to have strong revenue profiles, even in a more modest economic growth environment. But if everyone's costs are going up and margins decline, it's going to be a real, I think, sort of a rotate away and risk off moment for the equity markets.
Is that going to be a bigger problem for companies in Europe, Kate?
It's potentially a large problem, Kailey. And, I think European companies don't tend to be as dynamic. They tend to have fairly high costs, a fixed cost base relative to U.S. companies. And of course, they have the labor component as well, which is more sort of stable versus dynamic in the U.S. The revenue growth profile for Europe was not outstanding before this conflict in the Ukraine, and it's something I think that will have to be revised down. As I mentioned at the top of our conversation, analysts have not cut their earnings estimations for full year 2022, and I think that's something we're going to have to watch very closely over the next coming weeks. If we take down our earnings, we take down our revenue expectations. If inflation, particularly on the energy side and the food side, really hits into consumption in Europe, it's going to be a much tougher slog. I have a preference for U.S. over European equities at this point.